Are you studying for the SIE exam? Let's go over the most important terms you need to know to pass with confidence. Let's start with the basics, and we'll move on in our future videos to some of the more complex topics. Capital markets and regulators. Let's start with the regulators. The SEC regulates the securities industry. FINRA oversees broker-dealers, and you both work to protect investors. FINRA is what is known as an SRO, a self-regulatory organization. The primary market. The primary market is for new issues. Issuers create them, underwriters bring them to market, and broker-dealers sell them. The Securities Act of 1933 requires full and fair disclosure of all new issues through a prospectus. A prospectus gives all the information on an IPO, and you cannot solicit business without it. It cannot be altered, written on, or have anything attached to it. So, no little scribbles on what you think are the key parts, no post-it notes. It has to be clean and pristine. The secondary market is where investors buy and sell securities from each other after the original issuance. It includes stock exchanges like the New York Stock Exchange and Nasdaq and helps provide liquidity. For your SIE exam, remember that no money from these trades goes to the issuing company. This is where you buy and sell with each other, and this is where your market makers are. A designated market maker is a member of a stock exchange like the New York Stock Exchange who maintains fair and orderly markets in specific securities. For the SIE exam, know that designated market makers buy and sell from their own inventory to provide liquidity and reduce volatility. Common stock means ownership. A company will authorize a certain amount of shares, the authorized stock. Then they will issue shares, which is the issued share amount. What they buy back is called their treasury stock, and what is still outstanding with the public is called outstanding shares. Other types of shares. Preferred stock offers fixed dividends. Bonds are loans you're making to issuers. Mutual funds and ETFs give you diversification, and options give you the right to buy or sell a stock. We'll look at more of those in a future episode. Alternative investments. REITs invest in real estate and pay out most of their income. They have to pay out 90% to avoid income tax. Annuities offer income for life and are sold by insurance companies. Regulation D, private placement. Regulation D is a federal rule that allows companies to raise capital through private placement instead of public offerings. Unlike public offerings, private placement don't have to be registered with the SEC prior to their sale. For the SIE exam, remember Regulation D offerings are mostly sold to accredited investors, institutions, and insiders, and there are limits on the advertising they can do. There is also limits on reselling the stock. The stock cannot be sold for 6 months, and Form D must be filed with the SEC after they are sold. One key point to remember about Regulation D is the assumption that the investors are sophisticated. So they are accredited investors, institutions, and insiders, and they can sell to up to 35 non-accredited investors. Accredited investors are considered to be retail investors, but they are considered to be a more sophisticated retail investor. They have to meet certain criteria to be an accredited investor. You need to know these for the exam. One is that they can have $1 million of net worth, not including their primary residence. The other is that they can have $200,000 in annual income, $300,000 if it's a married couple combined. And also people that hold a Series 7 or a Series 65 can also be accredited investors. The keys for the exam are to know that an accredited investor has an annual income of at least $200,000, $300,000 for married, or a net worth of $1 million, not including their primary residence. Market orders execute immediately. Limit orders set your price and may or may not execute. Stop orders protect you from losses. Margin accounts let you borrow, while cash accounts require full payment. Keep in mind that custodian accounts like UGMA and UTMA for minors cannot have margin accounts. Important pricing terms. The bid-ask spread is the difference between what buyers want to pay and what sellers ask. Buyers buy at the ask price, the higher price, and they sell at the bid price, the lower price. The difference between the bid and the ask is called the spread, and that is the profit for the dealer. For the SIE exam, you need to know what capacity a broker-dealer is operating in. When they are a broker, they earn a commission. Agency, broker, commission, ABC. When they buy or sell from their own inventory, they are a dealer, and they charge a markup or a markdown. Principal, dealer, markup. Keep these in mind for your exam. ABC, agency, broker, commission, PDM, principal, dealer, markup. The business cycle. Definitely need to know this one for your exam. The business cycle follows a specific pattern of expansion, peak, contraction, and trough, and then it repeats again and again. Market conditions. Bull markets rise, bear markets fall. The government has many government corporations that invest in things like mortgages. They have Ginnie Mae, Fannie Mae, Freddie Mac, and then for student loans, they have Sallie Mae. You will need to know that Ginnie Mae is the only one of these that is fully backed by the federal government. So keep in mind for your exam, Ginnie Mae, that's the one fully backed by the U.S. government. You are one step closer to passing the SIE exam. Thank you for spending your time with us. We'll love to see you in our next video. Please subscribe to our channel and like and share our videos. We would love to hear your comments on how we can help you pass the SIE and any of your future exams. And if you pass, we would love to hear in the comments how we helped you. See you next time. Bye.